Dividends seem like a natural way to invest for retirement income. You can either buy a portfolio of high income stocks or you can go for a fund which generates high dividends. Either way, you don't have to sell anything and you can live off the income. However, this strategy comes with some big risks, which I dig into in this video, but I also consider better strategies at the end of the video, which I think are more likely to be successful. This video is sponsored by Koifin, which is a provider of live market data and powerful analytical tools, some of which we'll see later. So let's dig into how to dodge dividend disaster in a bit more detail. Now, conceptually, it's pretty simple to build an income portfolio. Let's say we've got a 30-year retirement period. We just buy a portfolio of high income stocks at the beginning of the period, or we buy a fund that generates lots of dividends. And then we passively sit there and receive those income payments on a regular schedule. But as you probably guessed, in practice, it's not that simple. Here I've chosen a UK high income fund, and this is the iShares UK Dividend UCITS ETF, and the ticker for that is IUKD. Now in the US, there are lots of equivalent funds. I've chosen this one because it's got a lot of dividend history, and we can see what would have happened if we go back in time and build a retirement portfolio using this fund. These are the actual dividend payments, the blue bars you can see over time. And this is between 2014 and 2023. So here's the first payment in 2014. This is 6 pence. The next payment is 13 pence. And these payments are per share that you own. So if you want twice as much, you just buy 2 shares. Another way to think about this is how much do you have to pay for this income in order to receive it in future? So a measure that people often use to compare income funds is to look at the dividend yield. That's the income over some period divided by the price you pay today, expressed as a percentage. So let's look at that here on Koifin. I'll expand this top panel, which is that dividend yield over time. And you can see that at the moment it's pretty high. It's over 6% in August 2023. It tends to spike when markets crash. So here you can see on March 19th it reached 9.7%, but typically it varies between about 4% and around 7%. But notice how variable those dividend payments were, but also the dividend yield. And that makes planning retirement with one of these portfolios tricky. So let's pretend we're building one of these income portfolios using that very fund in 2006. Now the median income in the UK in 2006 was £23,000. So to generate a £23,000 income, we'd have needed about 47,000 stocks of that IUKD fund. That's because each stock in 2006 generated 50 pence. And it wouldn't have been cheap to buy 47,000 stocks of IUKD. It would have cost us about £500,000. So what I show here is that income from 47,000 shares of IUKD. Now I've also aggregated the total dividend payments over the course of each year. So in year 1 you can see, yes, we've got about £23,000. In year 2, which is 2007, we'd have got a bit more, and even more in 2008. But in 2009, notice what happens is that the income collapses. And that's because companies don't have to pay a dividend. If they're worried about not surviving through a period of economic hardship, they'll cut their dividend. It's not like a bond where if they don't make a corporate bond payment, they'll go into default. Dividend payments are voluntary. And although it may not be popular with their shareholders, companies can cut their dividend in order to survive a tough period. Notice again what happened after the dividends recovered following 2009's slump is that in 2020, when we had the pandemic and lots of people were staying at home, companies in the UK cut their dividends again. So if there is a crisis like the pandemic or the financial crisis, then companies will cut their dividends, and that makes life for you as a retiree dependent on those dividends very difficult. But it's not just the volatility of the income payments which is a problem for a dividend income portfolio. There's a much bigger problem. So we saw the median salary in 2006 was £23,000, but because of inflation, the rising cost of living, generally what happens over time is that incomes increase. So the income at the end of this period in 2022, the median income in the UK, increased by about £10,000 to £33,000. However, look at our income. it didn't increase over that period of time. If anything, it seems to have fallen slightly. So this is a massive problem. If your income portfolio doesn't match the rate of inflation, doesn't grow as quickly as inflation, then in real terms, you're going to get poorer. So let's imagine that in 2006, we crafted this portfolio to just pay our bills, which come out at £23,000 a year. Well, if we adjust upwards the cost of living between 2006 and 2023, the cost of living almost doubled over that period to £37,000, but our income didn't increase. So this is the other way of seeing the problem with inflation. We have to match inflation, otherwise we won't be able to pay our bills. Another problem is that the actual value of our investment, if we decide to sell the fund, would have fallen over time with this fund. So let's say we'd have invested £100 in 2005 and we track that over time. The green line shows the value of the fund. Now notice how it falls to 66.5. If we lay on top of that the 40% decrease in the value of the pound in terms of its buying power, that means that the overall value of the fund in terms of its buying power, if we wanted to sell it and use it to pay our bills, would have fallen by a catastrophic 60% over this period of time. So both in terms of falling income, but also falling capital value of our investment, this fund would have been a complete disaster. And in the worst case, what could happen is that we could enter a dividend doom loop. So the first problem, as we saw, is that our dividends, our income, lagged behind inflation. That means that if we wanted to top up our income, we'd have had to sell some of our fund itself. Now, if you've sold some of the fund, the dividends you receive are proportional to the number of shares that you own. So less shares means less income again. So both from the erosion of the value of the income itself because of inflation, but also because we're having to sell some of the fund, what we could end up with is a portfolio that gets rapidly depleted, and it may run out of money before we die. So that's pretty much a worst case. So what went wrong in this case? Now, you've probably heard that stocks beat inflation over the long run, and for most stocks this is true. But what that depends on is the ability of stocks to increase their profits. Stock prices generally track those profits over time. Now, a company is more able to grow its profits if it can grow its revenue. How can it do that? So let's imagine we've got a chocolate factory. Well, we could buy more chocolate making machines. We could reinvest that money back into the company if we have profits at the end of the year, make more machines, make more chocolate, and increase our revenue organically. Alternatively, we could take some of our profit and pay that to our shareholders as a dividend. However, if we're paying a lot of dividends, then we won't have enough money to reinvest back into the business to generate greater profits, and that's going to slow down the capital growth of our company. The share price just won't increase as much. Now, for the UK historically, stocks have tended to be very generous dividend payers because that's what our pension funds and our investors have demanded. But as a result, the capital gain on UK stocks has been very poor if you compare it with, say, the US, where there's much more of a growth model. US investors expect capital growth over time. Dividends are usually less generous, and that's generated much greater capital growth in the US compared to the UK over a very long period of time. In fact, you could almost think of UK investors as vampires. They're sucking the lifeblood out of UK companies in order to be able to service those big dividend payments. But as a result, effectively we've weakened our companies such that they can't grow their revenue. So how much of the lifeblood are we sucking out of our companies? Well, one way to measure that is using something called the payout ratio. If you look at the amount of profit which a company generates and look at the percentage of that profit which is paid as a dividend to shareholders, that's called the payout ratio. So what I've done here is I've looked at the payout ratio for the NASDAQ 100, which is a very growth-oriented tech index in the US. So along the x-axis here, you can see that payout ratio with large payouts on the right. This is when the vampires are sucking a lot of blood. And then on the left of the graph, we've got lower payout ratios. So here the vampires hardly take any blood at all. And then on the y-axis, I've got the capital gain of stocks over the last 5 years. Notice that companies which have the lowest payout ratios, which tend to be more growth oriented, are the ones which have the greatest capital gain. This shows the trade-off very clearly. A bigger payout ratio means a smaller capital gain. In turn, what that means, if the payout ratio is too high, is that you may not be able to keep up with inflation in terms of dividend growth. So a very high dividend payout ratio may be unsustainable. So if we look at some of these mega cap 8 growth stocks in the United States, such as Nvidia, the payout ratio is tiny. It's only around 3.9%. But the capital growth has been absolutely huge, at 600% over the last 5 years. Similarly, Apple has a payout ratio of around 16%. It tends to compensate its investors by buying back its own shares at something called buyback yield. But for this stock, you can see the capital growth has been huge again, 230%. And if we look at large caps in the United States, 500 of them in the S&P 500, you can see this negative relationship between payout ratio and capital growth very clearly. Now you've probably seen I've been using Koifin in this video. It's something I use every day to talk about markets. You've probably seen me use it on YouTube Lives to talk about what's going on. If you're a viewer of PensionCraft, you get a special offer from Koifin where you get 15% off your subscription. To make use of that, just use the link in the description below. So we've seen the problem with income that doesn't match inflation. What are the potential solutions? How can we avoid that catastrophe? I think the problem is that people use the wrong metaphor when they're thinking about their retirement portfolio. They're thinking in terms of the parable of the goose that lays the golden eggs. Here's the jolly farmer with his pipe who's just discovered that his goose can lay golden eggs. So this is like a dividend fund which pays a high income. But the foolish farmer sells the goose. But in order to do so, he kills the goose. And the motto here is, greed to need doth surely lead. So this encourages us not to sell stocks, merely to hold stocks which generate high income, and essentially preaches vampirism. Here's a metaphor which I think is much more useful, and this is to think in terms of total return, not just income, but also capital gain and what's sustainable over time. So let's use a farming metaphor. Let's imagine that we're kind of planting seeds. So let's start off with 100 shares, or £100 worth of shares, or $100 worth of shares. And let's imagine that every year, the size of our portfolio on average increases by 6%. Well, that means that we could harvest, say, 2, 3, 4, even 5% per year, and the size of our portfolio on average wouldn't shrink. So the concept here is one of a perpetual withdrawal rate. What's the rate at which you can take money out of the portfolio without shrinking the size of that portfolio? And yes, that means we're going to have to sell some of the funds that we own. But nowadays we've got things like fractional shares, and it's also very easy and cheap to sell those shares. We also have many tax accounts where we don't have to pay capital gains when we make those sales. But would this portfolio beat inflation? Well, by focusing on total return, yes, it will. And that's because if you look back 120 years, and this is looking at the Credit Suisse, or possibly now the UBS, Global Investment Returns Yearbook from 2023, US stocks have beaten inflation on average by over 6% per year. Compare that with bonds, and they've only beaten by about 2% per year. If we look at the UK, the numbers are similar. Stocks have beaten inflation by around 5% per year, and bonds by around 1% per year. So that immediately tells you that the perpetual withdrawal rate for the US and the UK would be something around 3 or 4% per year, maybe even 5% depending on the portfolio. And I've made a video all about perpetual withdrawal rates, and that'll be linked to in the description below if you're interested. But really the story here is that if you are trying to build a perpetual portfolio, then really you have to be careful that you do match inflation long term. If you don't, you will enter this doom loop potentially where your income is falling in real terms. Now, if you are going to go down the dividend stock route where you choose a portfolio of stocks which pay high dividends, the key thing is to focus on sustainability of that dividend. Don't go for payout ratios which are too high. Look at the dividend cover, what proportion of the profits of the company are left over after it's paid its dividends. A large dividend cover means that there is a surplus so it can grow its dividends in future. It's not being bled dry, to use our vampire metaphor. So for example, if we look at this fund, which is a US fund, this is the Invesco S&P Ultra Dividend Revenue ETF, ticker RDIV. There you can see that these dividends are slowly growing over time. Now that fund is tracking this index, the S&P 900 Dividend Revenue Weighted Index. Now this starts off with the S&P 900, which includes the S&P 500 large cap stocks plus another 400 mid cap stocks, and then it tilts towards the stocks which have the highest dividend yield. But notice what it does is go for stocks which have relatively lower payout ratios. On the face of it, that seems kind of crazy, but really it's just going for sustainable dividends. And then the final deviation from a normal market cap weighted index is that the index is weighted by revenue. So companies which have a higher revenue, top line income, those companies will receive a larger weighting in the index. So that ensures, I suppose, that the companies can afford to pay their dividends because they'll have lots of revenue and, let's hope, low costs. But even for that index, what we can see is if we compare the total return, capital gain plus income over time, that's the blue line you can see here for the index, that underperforms a simple market cap weighted index by total return. So you'd have been better off with the S&P 900 without any of this fancy weighting or tilting to high income. So even for this index, you can see you'd have been better off just buying the S&P 900. So personally, I think it's better to focus on total return and not tilt towards dividend necessarily. If you do have short-term cash requirements, you can always do that with single government bonds because you can just choose the maturity dates to fall on whenever you need the cash. And those are very safe investments. But if your focus is on income, then just be absolutely sure that you're not becoming a vampire. Now don't forget our offer from Koifin, and if you do want to learn more about that and benefit from their discount of 15%, there'll be a promotional link in the description beneath me. And, as always, thank you for listening.